Hi, welcome to Solution in YouTube channel. In today's video we will learn about unearned revenue. Unearned revenue is money received by an individual or company for a service or product that has yet to be provided or delivered. It can be thought of as a prepayment for goods or services that a person or company is expected to supply to the purchaser at a later date. As a result of this prepayment, the seller has a liability equal to the revenue earned until the good or service is delivered. This liability is noted under current liabilities, as it is expected to be settled within a year. Some common examples include rent payments made in advance, prepaid insurance, airline tickets, prepayment for golf club subscriptions, etc. In case of advance rent paid by customer, the house owner cannot recognize the revenue immediately on receipt of rent in full. As soon as the tenant has used the house for each month, the revenue portion of that period will be recognized as revenue. Similarly, the insurance company will recognize the insurance premium after each month has lapsed. The airline ticket revenue will be recorded as soon as the passenger has traveled through your airline. The golf club will record the revenue as soon as 1 month passes and member has used club services for a certain period. Let's see how to record unearned revenue. Unearned revenue is recorded on a company's balance sheet as a liability. It is treated as a liability because the revenue has still not been earned and represents products or services owed to a customer. As the prepaid service or product is gradually delivered over time, it is recognized as revenue on the income statement. If a publishing company accepts $2,400 for a one-year subscription, the amount is recorded as an increase in cash and an increase in unearned revenue. Both are balance sheet accounts, so the transaction does not immediately affect the income statement. If it is a monthly publication, as each periodical is delivered, the liability or unearned revenue is reduced by $200, that is, $2,400 divided by 12 months, while revenue is increased by the same amount. The following journal entry will be passed at the time of cash received in advance. Debit to cash account, and a credit to deferred revenue or unearned revenue. Upon 1 month end, the revenue for 1 month will be earned automatically and we should transfer it to the income statement by passing the following entry. Debit to unearned revenue and a credit to sales revenue. Unearned revenue is usually disclosed as a current liability on a company's balance sheet. This changes if advance payments are made for services or goods due to be provided 12 months or more after the payment date. In such cases, the unearned revenue will appear as a long-term liability on the balance sheet. Let's take a real example to understand unearned revenue. Netflix Inc. offers a line of products and services for the entertainment industry, including TV series, movies and more. Many of its products are sold through subscriptions. Under this arrangement, many subscribers pay up front and use the product over time. This creates a situation in which the amount is recorded as unearned revenue or, as Netflix calls it, deferred revenue. At the end of the second quarter of 2020, Netflix had $1.117 billion in unearned revenue, up from $925.74 million from the prior year end. The company classifies the revenue as a short-term liability, meaning it expects the amount to be paid over 1 year for services to be provided over the same period. Unearned revenue can provide clues into future revenue, although investors should note the balance change could be due to a change in the business. Netflix increased quarterly and monthly invoices but is less reliant on upfront payments from annual invoices, meaning the balance has been growing more slowly than in the past. There is another term called unrecorded revenue with revenues that were earned, but not yet recorded in a company's accounting records. For example, an electric utility will provide electricity to customers for up to 1 month before it reads the customer's meters, calculates the bills and records the billings as revenues and accounts receivable. As a result, the electric utility will have up to 1 month of unrecorded revenue. At each balance sheet date, the utility should accrue for the revenues it earned but had not yet recorded. This is done through an adjusting entry that debits a balance sheet receivable account and credits an income statement revenue account. I hope you have now a basic understanding about the unearned or deferred revenue. To learn more with solved question answers, click on the link given in the description. If you like the video, please hit the like button and don't forget to subscribe for more videos. See you in our next video. Take care.